Hello everyone and welcome to the OANDA Market Pulse Bank of England Super Thursday preview. My name is Craig Erlam, Senior Market Analyst at OANDA. Now I know currently in the markets it's been extremely volatile. This week was always likely to be relatively volatile because not only do we have the US presidential elections next week, which was looking almost wrapped up to an extent prior to the events of last Friday, but we've also got 4 central bank events this week, 2 of which we got out of the way on Tuesday, one of which is what we're due to talk about now, and another one is was the Federal Reserve decision, which at the time of recording is in a few hours' time. But obviously, the events of Friday have complicated matters, and attention very much now is focused on the US, given the fact that the new investigation into Hillary Clinton's emails has really caused a lot of turmoil in the polls. Clinton had a very clear lead, and now that looks to have been almost completely decimated, and there's certain polls which actually suggest that Donald Trump is in the lead, and what that has done for the market is meant that an effective Trump risk has had to be priced in, seen as that is generally seen in the markets as the least favorable outcome. We're seeing a fall in the Mexican peso. We've seen the Trump hedge, as it's being called, in gold, with gold now currently trying to break through $1,300 and so on and so forth. But what this means is, because this isn't obviously an election video, what this means is that there's been a little bit less attention on the Bank of England, and it's still a big event tomorrow, and there still could be a lot of volatility on the back of it, particularly in the pound. You can see here that the reason why we call it Super Thursday is because not only do we have the Bank of England interest rate decision, which is expected, as you can see here, to remain at 0.25% for I think it's the 3rd month in a row, you can see here. So it fell to 0.25% in August, and it stayed there in September. So it stayed there in the middle of September, and we're expecting it to stay there once again. But we also get, obviously, the asset purchase facility decision, which is expected to remain unchanged, as you can see there. But what makes this one important is, aside from the minutes, we also get the quarterly inflation report for the Bank of England, which contains its new economic forecast, so that's GDP and inflation. And we'll also hear from the man himself, Governor Mark Carney, who only on Tuesday announced that he was going to remain Bank of England governor until 2019, until the Brexit negotiations have been completed, having previously only committed to 2018. What this means is he won't fulfill the full 8-year term, but he was never expected to initially. And I think this period of stability at the Bank of England throughout the negotiation process with regards to Brexit is going to be very welcome, and has been very welcomed by the markets. But what makes this again very interesting is the fact that the Bank of England took a very pessimistic view ahead of the referendum in June. It obviously acted extremely quickly after the referendum as well to cut interest rates by 25 basis points, as we saw there, to increase its bond purchases by £60 billion, to announce a new £10 billion corporate bond buying scheme, and also to launch the term funding scheme to try and free up liquidity for lending for households and small businesses. Now, the act of this by the Bank of England did obviously raise a lot of criticism that they'd been too pessimistic in their warnings, that they'd taken a political side effectively, and this is something that Mark Carney will want to remove from people's perceptions, given that the Bank of England is expected and is meant to be entirely independent. Still, the economy has performed better than the markets did expect, and better than the Bank of England expected prior to the referendum. Now, there is a couple of reasons I do think for that. For one, the Article 50 hasn't even been triggered yet, so Brexit hasn't even happened at this moment in time. But we have seen a significant depreciation in the pound, and we have also seen we have seen a significant depreciation in the pound, but we haven't yet seen that filter through into things like inflationary pressures, which is going to certainly have a negative impact for business confidence. It's going to have a significant impact for consumer confidence, and that is when we're going to start to see having a broader impact on the economy. But thankfully, we haven't seen that this happen yet. But what we have seen is the boost from things like tourism and exports that comes with the depreciated currency, and that's why we did get that decent GDP figure of 0.5% in the third quarter. Now, what people want to really know is what is the Bank of England's expectations going forward, and how does that impact monetary policy? Because ultimately, that is what's going to really drive the pound going forward. And this is what we'll get from the new economic forecast that the Bank of England will release, and we'll hopefully look for a little bit more insight into what the Bank of England is planning. You'll remember at the August meeting, they unleashed all these stimulus measures, and what they said at the time was if the economy performs in line with its expectations, then it will probably announce further stimulus before the end of the year. I think it's quite clear right now that the economy has beaten the Bank of England's expectations, and at this moment in time, people have written off the possibility of another stimulus package from the Bank of England before the end of the year, but we still want to know exactly when we can expect the next one, assuming, of course, that we are going to see a deterioration in the data, which will ultimately force the Bank of England's hands, and this is what's going to really be the key driver for the pound tomorrow. Now, if we just take a look at a few currency pairs and also the FTSE 100, I think right now this is the wrong chart. This is the euro dollar, although we have seen some very nice moves in here up towards 111.20, which is now a significant zone of resistance for me, 111.20 through to around 111.90, 112 I think is a significant zone of resistance as far as I'm concerned, but we're not here to talk about that. We're here to talk about the Bank of England and the pound now is trading at the top end of its range. The US election has really provided a distraction, I guess, from the pound sterling, and when you're looking at the dollar, we have seen a big sell-off in the dollar over the last couple of days in response to that. What it's done is that's brought us back towards the top of what we've got here is the post-flash crash trading range. The flash crash you can see here happened on the 7th of October, just under a month ago now. So if we nip down to the 4-hour chart, you can see that we've just established this nice trading range in the pound against the dollar between around 121 and around 123 to 123.50. We're trading at the top end of that range now on the back of the weakness in the dollar. If we see anything that's remotely hawkish from the Bank of England and from Mark Carney that would suggest they're not anticipating any stimulus, for example, in the first half of the year, then I think we could expect to see that break up towards these 124.50s to 125s and potentially even back up towards maybe the 126 levels, especially if they're accompanied by strong economic forecasts. The alternative being if we see a dovish message from Mark Carney and the Bank of England, maybe suggesting that they expect further deterioration in the economy in the first quarter of next year and an accompanied rate cut or further stimulus, then we could see that as a catalyst to move back towards the lower end of this range. Now you can see 122 support there being found in the interim, but ultimately 121 offers the main support here in cable, and that is where we've been stuck now, like I say, for most of the last month. Obviously a break below here may open the door to a move back towards around 120, which I think could provide some near-term support for now. Euro sterling is another one where we are seeing a different story really to pound against the dollar, because we're not seeing the same kind of weakness in the euro that we have seen in the US dollar. Clearly we're still in an uptrend at this point. You can see that ascending trend line on the chart right in front of you. Really support can be found here around 89.20, and a break of that trend line would potentially suggest we're about to see a correction in the pair. Further confirmation of that could be found from a break below 88.80, which is the most recent low. Break of the two of those does start to look a little bit worrying for the euro sterling bulls. However, any weakness in the pound, when we're looking at around 91 to 91.50 being the major resistance zone, with a break through that potentially prompting a move back towards around 94, which is a long time resistance. If we have to scroll right out here towards, you can see this is the 94 highs from around October 2009, which is the next major level of resistance through here. The penultimate chart we're going to look at is sterling yen. The yen we've seen on things like dollar yen. We've seen a break to the upside through the cloud where it had traded below since the start of the year. In euro yen, we've seen a little bit of weakness in the cloud being tested. We haven't seen that yet in sterling yen, simply because of the pound sterling itself is still quite weak. So it's almost a battle of the weaker currencies at this moment in time. The result of this has been an established trading range between around 125 and around 129, where it's been lingering recently. And again, this is the trading range we're going to be keeping a close eye on. A break above 120, 129 following the Bank of England could see some pressure arrive towards the upper end towards the clouds and the moving average band here. I think it would take something quite significant for that to happen, but we could find temporary resistance around 132, which is this prior level of resistance here. A break below again would obviously result in a continuation of the move lower, or would suggest we're going to see a continuation of the move lower, at which point we could be looking back to around 121, which once again is a longer term low. Final thing I wanted to highlight is the FTSE 100. FTSE 100 typically benefits from the weaker pound, and we did see that a lot post-Brexit, but we're seeing general weakness in the indices right now. Finally, following the break of the neckline of the double top here, we have seen the projected level. So you can see the double top formed here. First high, here's your neckline, second high, and then it broke lower. We've seen that projected lower by the same again. For those of you who don't know, if you see a double top, then typically, as per the textbook, you'll possibly see a projected move from the top of the double top through the neckline, projected lower again. That has finally been completed in the last 24 hours, but yet it continues to trend lower. Now, we saw the break of the trend line as well, which was particularly bearish. We've now seen a series of lower highs and lower lows. Technical support can currently be found around 68.25, 68.30, below here around 6,800 to 67.70 being the most recent lows. But to be honest, if we see a break through the 68.20s here, then I'm starting to get a little bit more concerned here. I think a lot of the indices right now are looking relatively weak and could be in for something of a correction. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.